David, thank you, Anka. It's great to be with you all. It's Price Headley here at BigTrends.com, and an early happy Thanksgiving to each and every one of you and your families. Obviously, it puts Thanksgiving in a whole new perspective with what a year 2020 has been for so many, and we feel so blessed at Big Trends that just had our 21st year anniversary, and really something that I've been teaching people throughout these last couple decades about the importance of staying flexible in your trading. Do not get locked in to any view on the markets, and that's what I think is so great about technical analysis and so many of the speakers here that have a unique patterns that focus on the price action. So we're going to talk about that price action and how you can trade a small account with $1 options. In fact, you can trade a big account with $1 options too, but I tend to encourage people to start small and build with any approach that you're implementing. If it requires you to put in too much capital that you're not comfortable with, then basically you won't be following the rules properly. You'll get emotional in your trading, and emotion is something that I always am seeking to take out of the trading process and say, look, you got to be systematic. You can't get too high or too low. You've got to have a method to the madness so that you can actually make sure that you can make order out of what seems like sometimes day-to-day chaos in the markets. So there's a lot of patterns at work out there. We're going to share with you what we call our Grand Slam options pattern today. That's definitely a more aggressive options approach, but this has really been one of my favorites. So reminder, everything I'm sharing with you is for your information and education only. You know that this is not a recommendation of buy or sell any particular security. Of course, you know that you are solely responsible for your investment decisions. And Big Trends, we don't provide individualized personal advice. What we do is we take our research, put it out through real-time email and text alerts to subscriber groups like our Grand Slam options traders. And it is getting near the end of the year. So do check with your tax advisor on ways that you can actually help make sure you help your tax situation so you keep more of what you earn. Now, the baseball season has ended, the World Series. Congratulations to you Dodgers fans out there. But the baseball analogy works really well for what we're after here in this option strategy. There's a lot of people out there that have gotten comfortable with settling for making small profits in the options market because, frankly, they probably tried to trade and make bigger profits and they probably got burned because they weren't doing it right. And so a lot of times people think, well, therefore that's a bad game because I lost money. But maybe you just weren't doing it right. In this case, we do not want to get to just first base and hit a single in a baseball analogy and just take the smaller gains, because you're leaving the bigger upside of the whole point of that options exists, and the point that attracts us in the first place is the theoretically unlimited upside. Now, we do take profits gradually, so we look for at least a double, which of course second base is a double in baseball terms. Double in investing terms is 100% gain. I've always advocated, whether you trade options, stocks, Forex, futures, whatever vehicle you like to trade, if I get a double on any investment, any trade that I make, I sell half of it no matter what. My experience is what this does is it gets your risk capital back in your pocket, and it frees you both financially and emotionally to let the trade run potentially to an even bigger gain. Sometimes they do, and sometimes they don't. So once you've taken that sort of that emotional and financial risk capital element off the table and said, now people call it the market's money. I don't. I call it, it's still your money, but now it's what we call a free trade, meaning that psychologically you can be free to let that trade run even more. When we can get our next target, which is a 200% gain, a triple in baseball terms is third base, a triple in investing terms, of course, is a 200% gain, 3 times your money, but 200% profit, saying, okay, then we take another half of our remaining half. So a quarter of our original investment on that triple at a plus 300%, we take all of the rest off. So the final quarter of our remaining position. We don't try to hold the whole thing to 300. We want to take profits gradually so it helps to reduce risk, but also keep letting good trades work for you. Too many traders these days, like I said, are getting comfortable taking a small 20% type of a gain in an option trade and leaving the doubles, triples, quadruples to somebody else like me and our Grand Slam option subscribers. Meanwhile, taking bigger losses when they're wrong. And that's not how you want to trade, is winning small and losing big. You want to actually control your losses and let your winners run. So that's what we're doing here. And the result since the beginning of 2017 on a model 10K portfolio would grow to $33,500. That'd be a $23,500 profit. before commissions. And one of the best things that's happened to traders in my 30 years of stock and options trading, I got started, for those that don't know me, after graduating from Duke University in '89. I got started in 1990, thought I knew it all, thought if I just worked as hard as I worked in school, I would make a lot of money because I just had a great work ethic and continue to have that. But bottom line is that that's not enough in trading. If you dig in even harder on a trade that's not working, you can lose even more. So you've got to get the trend right. And that's when I switched quickly from fundamental analysis as my driving factor to technical analysis, when I realized it's all about finding these trends and these momentum moves. And so the point being that, okay, yes, this isn't a guarantee of future results. We can make more or lose more depending on different market environments. But my belief is that even with 21 years of big trends now, bottom line is that we're getting better and better all the time. It's finding new patterns, new little tweaks that help give us even more winners and that help us control risk along the way. AMD would be one of my favorite names, Advanced Micro Devices, here in 2020, the tech name. It's really taken on the leadership mantle away from names like Intel. We did just score a double on Micron Technology and the MU, another tech name, here in the past week. But bottom line is that AMD was one of these that hit the 100, 200, and 300% profit in 2 trading days. You'd say, how is that possible? A big part of it is you don't get stuck waiting, holding, and hoping. You cannot do that with options buying. And that's why so many traders buy options, lose money, and then say, I'll never do that again. Or hear a horror story of somebody that blew themselves up because they didn't do it right. So the thing is, like, when we see a setup pattern here, we're going to teach about these indicator lines here. We've got several of them up here. We've got the CCI is going to be the Commodity Channel Index. We'll talk about that one. That's tied to commodities, but we use it for stocks as well. When it goes over bot right here, same time that the percent R is going over bot, that's the Larry Williams percent range indicator in the second to last panel there. We got the ADX on this last panel here in green. That wasn't even signaling on that first setup, so it wasn't anywhere close to a buy. But that first CCI percent R is trying to get through that resistance. We call these my big trends bands, this upper royal blue line here, not following through. So the initial setup of a trade is where a lot of traders get a little too happy, a little too excitable, and say, I want to get in before everybody else. Do you ever have that feeling like, I want to be early, I want to be ahead of everybody else? The early bird gets the worm. All those kind of mottos go through our minds, right? But the reality is that the early bird oftentimes gets faked out and ends up waiting far too long and then gives up on the trade because you got in at the wrong time. Timing is everything in options trading. It's everything in a lot of aspects of life, but especially when we're buying options, because the time element is so critical. That you see this next setup happening here is right off of these next overbought points here. We're getting our setup, and then it's falling through. And the ADX, the green line, as I mentioned on the bottom, is also falling through above its key trend line. We're going to go into each of these indicators in more detail. We got that confirmation, check mark. We want to be in that next morning. Now, this is an example. You see this red candle here. That means that we opened higher, closed a little bit lower. We bought in off the open, and we were down that first day on the trade. This is a daily chart. Everything I'm showing you here today is keyed off of daily charts. Most of them are TradeStation charts with a few thinkorswim charts later. But the point being that what we're looking at here is that when you get a situation in which you are initially wrong on a trade, a lot of traders will panic and bail too quickly. My rule of thumb is that we expect these trades to start proving that to us within 5 trading days or less. So I give it 5 trading days of time on about a 1-month option. We'll get into that too. But bottom line is that you don't want to get too anxious or get a price stop triggered because you're trying to keep your losses down and think, I'll keep a tight price stop in there. You get whipsawed out of a trade like that, where you might be down 20 or 25% that first day on an aggressive out of the money option. These options, to get them at $1 or less, talking about a $1 option here, $1 or less means that you're controlling on $1 on 100 shares, so you multiply times 100, controlling 100 shares of stock for $100 in this example. So if we're putting $1,000 in, you can get 10 contracts for $1,000, $100 a piece times 10, and now you're selling half of it when it hits that double at plus 100%. Then you're selling another piece when it hits that 200%, which happened later that next day into the trade. And then that following morning, we're cashing out of the rest at 300%. So from that 2 mornings before entry, that second morning later, we're out at plus 300% on the final piece of the trade. Whatever happens after that, you have to be content that you don't care, you've gotten your money out of that trade. And obviously, think about it. If you take $1,000 in, you get your double, you take $1,000 back off the table, you still have $1,000 in that trade, then it goes on to make 200 and 300%, and you're taking $1,000 investment and you're turning it into like 2750, so it ends up being like 175% gain on the total position. That works out real nicely for helping grow your portfolio. When I think of baseball analogies for home run hitters, I think of the Babe Ruth, the Sultan of Swat, as he was called. 714 career home runs. But he, interestingly enough, he also had almost twice as many strikeouts, 1,330 career strikeouts. Now, we don't need a tutorial on Babe Ruth's legacy, but 6 championships on the teams that he played at least one at bat or pitch for. One of them he didn't. His first time with the Red Sox, didn't count that one. But bottom line is that I love this quote from the Babe. He says, "Never let the fear of striking out get in your way." And I think that's the worst 4-letter word that's hitting most traders more than any other 4-letter word I can think of. FEAR, fear, sometimes called false evidence appearing real. Bottom line means that a lot of people are being held back by their worries about either mistakes they've made in the past, which for the traders that I coach and work with on the psychology side, I call that the scar tissue of trading. That once you've been in trading for a while, you realize certain things you did wrong before, and if you don't, you'll pay the price again. You've got to learn the lessons of history to not repeat those mistakes, right? Same with your own trading. You should be studying, by the way, folks, your own trading logs. Are you keeping a log? Are you keeping track of your trade by trade, thinking of why did you get into this trade or that trade, and starting to track it through? Because if you're not learning from that trade. So a big part of this process is still, a lot of people get attracted to trading from the freedom, the financial freedom angle, that say, okay, I can be my own boss. I don't have to answer to anybody else. You still have to be the boss of yourself. You still have to answer to yourself, to your method, and to make sure that your method has a positive edge. So, Babe said, I swing big, I hit big or miss big. We'd like to hit big a lot of times, and we'd like to miss big as little as we can. Sometimes we will miss on trades, and you can lose what you put into some of these trades, but the key is that, we'll usually salvage a decent part of it even when it's not working, and move on to the trade with that 5-day time rule, which we'll get into. The great thing about, looking back at, say, March of this year, which was an incredibly difficult time in the stock market. The market dropped 30% from its February 19th high to the March 23rd low. In about a month, the market was down 30%. Everybody thinks that the market is so liquid, so safe, so diversified, but the reality is there's a lot more risk in this market than anybody would care to admit. The big thing is knowing when to be in and when to be out. So it's all about timing and saying, okay, you know what, when you look at this, you say, okay, how do we make money in March? We were up in the month of March thanks to not put trades on the downside, because I thought a lot of the puts were pretty expensive. We traded a couple of them, but our best success was actually Kroger calls, not once, but twice. March 5th of this year and also March 17th on St. Patty's Day. In both cases, we were out by the next day. So, see, the first one, we actually made our double target. I told my crew of analysts here, I was like, you know what? I can't believe I'm trading Kroger calls, but I've got to follow the system. I'd never traded Kroger in this service before in several years of trading, but I'm like, there is opportunity here because all of our indicators are lining up and says we need to buy here on this morning's, the prior day's breakout in this morning's opportunity. And we bought there from about $31 to $34. We bought the 33 strike calls. Now, if you're new to options, you buy a call at 33, that means you have a right to buy the stock at 33. Why would anybody want to buy that when the stock's trading down at 31 where we got in? Because those options are cheap, but they will become more expensive as it goes from 31 to 34. From out of the money to in the money is actually where you get some of the best leverage. We call it the gamma effect. We get the best leverage. Now, we were targeting a double. We do have brokers who can automatically trade it for our subscribers. So they send us what their average fill price is on the way in and way out for their various subscribers, not to any one individual. And we got an, actually, they told us one price, and then we thought we got in a little bit less at 91 cents. It ended up, they told us later they got in a little bit higher. We got in an average of 95 cents. So we only made 91.5% on that same day on that trade. Next day, it started to roll over. The market's looking dicey. We said, we don't want to let this thing go to nothing. And so we went ahead and cashed in the rest at 10%. So we made on that trade a little bit over 50% for a day and a half hold. Okay, the goal of this is usually about a 1 week hold. It's about what I expect it to take, but sometimes it can be faster or a little slower, and I'll show you multiple examples today. So we did this trade again when see it drop back off. We're out, so we don't have to endure this pain here while it's chopping around. The market's rough, but then it starts to fire again. You're thinking, hey, this stock's firing again. We want to get back into this trade. It's coming off of what we call a CCI retest. This blue line here had held that along with our big trends bands, which we'll get into as well. Got loads of stuff to teach you here. But bottom line is that you can see here that we're getting into this trade again right here, and it starts taking off that very same day. Look at how the stock goes from about 31 again to 34. And that you can see that very next day, it surges all the way up to 36. The options have gotten a little bit more expensive. We had to buy the 38 call. Say, how can you make money on a 38 call when the highest I ever got was just a hair over 36? Because you're trading it based on the market's expectations of how much more it could move after it's already gone from 31 to 36. So that next morning, we're cashing out half of the double. Dollar goes to $2. $100 a contract goes to 200. $1,000 invested goes to 2,000. Sell half, get that risk capital back in your pockets. And then I saw the same pattern happening intraday. I said, you know what, it's losing that momentum here intraday. And I said, let's go ahead and hop out of this thing. And we said exit and took the 92% on the rest. Average 96% gain for, again, a day and a half's work. So again, we missed that risk of that next fall off. As you know, the market's bottomed on the 23rd. Kroger bottomed a day or two later as a pandemic type of play. One of the few places as an essential store, if you will. Of course, a grocery, and they got a pharmacy too. Bottom line is that they're going to stay open even when other stuff's getting shut down. So that's a thing that you want to watch as we go through another round of shutdowns into the this pandemic second wave or third wave, whatever you want to call it. Bottom line is that whatever your opinions are on pandemics, presidents, markets, you have to trade what you see, not what you believe or what you hear about. That's the biggest thing that will cause you problems if you're not paying attention to what the market price action is doing. So the indicators I'm going to teach you about are not necessarily all ones that I've developed. Some I've modified or done different things with, but I borrow from, I call it standing on the shoulders of giants, people that have been around for a long time. Donald Lambert developed this in 1980 to track commodities. And then I said, you know what, I like what this indicator does, but I want to see if it works on big name stocks. And it works with most growth oriented stocks. A lot of tech, healthcare, biotech, growth situations, kind of big brand names. We'll walk you through some of the names we like to trade most with this method. The reason CCI is kind of different than most other indicators is it doesn't just key on closes. If you look at a moving average, it's looking at an average of the last, whatever, 20, 50, 100, 200 days closes to get that moving rolling average. Doesn't factor in the high and the low. CCI factors in the high plus the low plus the close divided by 3 to get what Lambert called a typical price. All that means is that it becomes a momentum indicator. If we're closing at the highs a lot, that's bullish. If we're closing at the lows a lot, that's bearish. What you're going to find from me, one of the most important things I want you to learn from my presentation with you here today is that overbought is not necessarily a bad thing. Let me say this again. Overbought is not necessarily bad. In fact, it can be powerfully bullish if a stock goes overbought and stays overbought. Why? Because let's face it, you and I as individuals are not driving the market. The institutions managing many billions and billions sloshing around out there looking for a place just like you and me. They want to make money and they don't want to lose. They want to limit their losses. And that's why when they see a good story, when it's good earnings, good trend, good sector, good market in general, they want to be piling in. They want to be taking advantage of it on the way out, on the way up. On the way down, they actually want to get out and limit their risk. So something that's going oversold can be a big negative. So overbought can be powerfully bullish. Oversold can be very bearish when the institutions are dumping the stock. Let's look at an example of this. This is Barrick Gold earlier this year. You can see that gold was trying to break out on this chart here. We look at our percent R, we look at our CCI. Both of those were trying to break out here into these big trends bands here, and we were not getting through there on that second day follow through or after. So you don't trade. You literally just stay out. Big X there, we're stuck in between those bands. I call that the no man's land within my big trends key indicator framework. I leave that to somebody else to try to pick those highs and lows. I do not scalp in and out day by day. I'm looking for the bigger multi-day, multi-point moves, because that's where you're really going to get paid as an out of the money option buyer, is finding these unusual big trends that catch everybody kind of flat-footed, and then they got to adjust and start rushing into this one. So this next setup point here, remember, now we get the percent R up here. We'll get into that one next. But the CCI I was just talking about is right here. And we go from blue to yellow. That's actually signaling that it should be a cautionary note for most people. But actually, if it closes above that first high, which it does right there, our ADX, as we said in green, is trending up now as well. All those things are saying there's a new big trend to the upside forming. So we get that confirmation, check mark, and we buy this next morning's open here. We don't fool around with these and try to get too cute intraday. We really want to get on board. We've got that confirmation. We know we need to get on typically that next morning, right around the time of the open, or soon after, as we get that early option pricing settling in. The stock was trading about 19 3/4. We're able to buy a March 20 call for 59 cents. That's $59 to control 100 shares of stock. So again, if you're putting in, you could do this, by the way, with as little as 4 contracts. If you're just saying, I'm going to go 4 contracts at a time, no more than $400 invested, 4 contracts would cost you $236. So you could do this with a very small amount of capital and get some tremendous leverage, even for small account traders. And of course, you can do it at bigger size too. The key is, do not overcommit your capital. We recommend 5 to no more than 10% of the capital that you are trading in the Grand Slam option service go into any one new trade at most. So you can trade less, but don't trade more than that. You just don't need that kind of volatility in your experience, because you get some big hits, and if you get a big miss, you don't want to be over committed on any one trade. Losses are going to happen. The key is managing those losses, not just financially, but also managing your own psychological states. You stay with the system through the little bumps along the way, and you can benefit from these kind of runs. So you can see we got in there, got our double that next day. So we're out of our risk capital back in your pocket, and basically now you're saying, okay, so now what do you do? Well, it keeps riding to the upside. It's grinding up. We got in just under 20. Say, hey, this is nice. It's grinding up, but it hasn't gotten our target. Then we walk in the next Monday morning, and it's gapping up more than a point to 22.5. At that point, we're right up near our 300% target. We say, look, we just want to cash in the other half of this trade, because remember, 250 and 200 and 300% average out is 250%. So we're getting better than our usual second half average on this trade at 289% and change in the 4th trading day into the trade. So we're going, that's very, very nice. We will take it and run. And you can see here, then it starts to reverse off of that opening exit price. It doesn't always reverse it. Sometimes we'll keep going. So the key is, whether it keeps going or not, don't worry about that. You've made your money. That's the sweet spot, as I call it. That's all you want to take advantage of. It's just that kind of that rush in phase as we get the confirmation of the trend up or down, and then you can move on to the next one after you book your profits. Or if we book a loss, you move on to that too. One of the things you don't want to do is constantly look backwards and say, did I do the right thing? Did I get out well? Did I not get out well? If you find that you play that game with yourself a lot, your ego is probably too involved in your trading. There's a time to study your past trades, typically on the weekends or at night. And in the heat of trading during the day, I want to be focused. I want you focused on opportunity, not on what happened in the past, but where we are now and what's going to be the next opportunity going forward. So it's a big mindset shift to not get into that ego game of what's our right or wrong, but rather focus on opportunity. Where's the next train leaving the station? I want to be on it for a new ride to another growth opportunity. Bottom line is ADX. This is another one that is not mine. It's Wells Wilder's indicator, one of the great trading innovators. He developed the RSI indicator and all kinds of other great technical trading tools. ADX was one where Wilder said, you've got to not just look at the high-low range when you're talking about the range for a day. You need to factor in the gaps as well. So essentially what ADX does is it says, okay, you know what, when we factor that greater amount of total price movement, how efficient is the uptrend? If we're getting higher highs and higher lows, of course, that's going to be a positive trend, right? And so when the DMI plus, the new highs are going up, the DMI minus, new lows are going down, there's your uptrend there on the left. That's typically going to be then pulling that ADX higher and picking up that we're in a trending phase. If ADX is flat or down, it means we're in a not great trending more of a trading range or choppy or questionable environment. So ADX becomes a real validator of the other trend indicators. So like when you look at one like say AstraZeneca, you know, they just came out with this news there, as you know, yesterday about, hey, they've got a 90% effective on the half dose and then the full dose trial, 90% efficacy or effectiveness rate. That sounds really promising, but then the other data looked a little bit more, you know, a little bit less effective, and the stock actually sold off, even though it was a catalyst for a market rally here. But you know what? We didn't trade it because the stock wasn't where it needed to be. We traded it in July when they said we're going to come out with our results in about a week with their partnership with Oxford University, and said, okay, yeah, I'm aware of the fundamentals, but I'm watching the chart and saying, okay, now the stock's breaking out here. Now we're getting that kind of confirmation. We know we need to be on board. And you can see in just a couple of days, we're getting our 100 and then 201% gains. Right on a Friday afternoon, we cashed out of that at that 201% target. So, okay, we need a little more ground to get to that 300%, but they're coming out with their results. Of course, they were positive in their tone. The stock initially gapped up, and then we said, thank you very much. We took our 357% on that early Monday morning rally, and then you see how the stock fell off after that. So part of this is finding that sweet spot. Part of it is also being proactive enough to book profits and not get greedy, not hope it's going to turn into 1,000% winner, but say, you know what, it's about taking money gradually as the market makes it available to us. So when we're right, if we're wrong, we still want to have a way out of the trade. We're going to talk about being wrong too. Love when newer subscribers are saying, hey, that was a great trade. Tim Q said it in Grand Slam. Kudos. So it's always fun to get those emails. We get them regularly from our subscribers. And so now you start to lay on these pieces. This third leg of the stool is the big trends bands. Now this is one that I said, okay, I need another way to visualize Larry Williams, who I've had the pleasure of working with, appearing on Fox News with, just in general being a big fan of Larry's work. And he developed this percent range indicator. He said, basically, you want to look at where that stock has been trading, whatever look back period you're looking at, and get a kind of a range essentially from the bottom 0 percentile up to the top 100% percentile. He looked at a little different scale. I like to use 0 to plus 100 kind of grade school style scale. But what you notice is if we're in that overbought top 20% of readings, it's like the 80-20 rule. Pareto's principle says the top 20% of those readings is where you're going to make most of your money, because the institutions are seeing the stock going up and they're going, I'd like some more of that, please. I want more, please, when it's going up. It's not interesting when it's going up. You wish you bought more contracts. When it's going against you, you wish you had less or none, right? It's that all or nothing mentality. We want to kind of smooth that out for you and say, look, take your piece out of this. You know, when this thing breaks out outside of that big trends band, then it confirms above there, there's our opportunity. We took that 100, 200, 300% on Baidu, 210 strike calls, about 40 points out of the money when it was starting that surge. This is one where it kept going after we got out. And I said, I don't care. I want to take advantage of this during that sweet spot. So you start to lay all the indicators on here, right? So percent R is right here. It needs to close above that high. It does it right here. Do we buy? Not quite, because in CCI, got to go above its level, and then we're getting that confirmation, and now we're buying in here. Okay, so we're saying we want to be on board, buying the 210 calls, catching that quick surge. And you can see, in retrospect, doesn't it almost look kind of parabolic here, right? And yeah, sure, I left some on the table there. I don't care, because I got my 300% in 4 days. If you can make 100, 200, 300% in 4 days, would you take it, even if it went to 1,000 the next day? Of course. You'd be glad to, because the idea is that, you know, it's about capturing opportunity as the market makes it available and not missing out so much. I talked to so many traders who have missed out on so much of this bull move with all the negative news, all the political election noise we've had, of course, the pandemic, so many reasons that have incited fear in so many people. I really believe fear is the thing that so many people have to overcome after this year more than any year that I've seen in my 30 years in the trading business. I started in 1990. I saw the first Gulf War with Iraq cause that fear in the fall of 1990. I thought that was bad. I saw the 2001 collapse coming. Barron's had an interview where I said in September 2000, watch out below. I had that 2-year bear market. I was in there twice saying, feature interviews, watch out below. And then 2008, I was on Fox News, September of 08, the beginning of September, right after that terrible jobs report. And I said, watch out below. This is going to get really ugly. And it did. But you know what? This year, obviously, even with the bounce back we've had, of course, with all the government stimulus and the Fed stimulus, thankfully is basically what saved the market. But the reality is those economic numbers were disastrous. The impact of the pandemic was brutal in such a short period of time. And so the key is that, you've got to be positioned to take advantage of not letting that fear hold you back, trading when you have a window. But what I love about this method is it doesn't leave you hanging in a trade very long. So you can see here's another Baidu example. This is where we had an earnings report on Baidu. I did not own it before the earnings. So big E here for the earnings right off of that gap up. And I said, okay, it's not quite where I need my indicators to be still. ADX is starting to go here, right? So that's good. But you can see we're not getting much happening for about a week after. We got kind of a triangle pattern forming here. And to me, it looks like it's starting to get ready to go on this one. As we come out of this triangle, I actually got in here when the CCI was, shorter-term CCI was coming on board with the %R staying in that overbought zone here. What you notice on these overbought phases, by the way, is, of course, that they stay overbought longer than you or I would usually expect them to. And so when things start going, we want to get on board. In about 4 days, we were cashing out at 102 or 100% actually on the first move. 200, 300% came on the 6th day. And this is one of those examples I like to show people, like we're out at that point at that plus 300 on the day 6 here. And on day 8 here, you're going, oh man, I wish I'd held on because it's up some more after that. Sure, went down on day 7, came back up, new high on day 8. You're going, what should I do here? And I'm going, don't be greedy. We've already taken our money out. Don't take the risk. If you're still holding on and going, oh, this thing's awesome, I'm glad I held, and he already sold out, you go, bam. You hate it when it drops down here and keeps on dropping and then drops even more the next day. Look at from where you got in, you would turn that winner into a loser really quickly if you're not taking a systemized approach to gradually taking that money off the table. So the key here is that trading involves risk. Even when things are going really well, you've got to always be cognizant that you're walking the next day and things could have changed. I think that's led to some people trying to day trade more this year than ever. And it kind of reminds me of 99 when I was just launching big trends in November of 1999. And I was telling people said, when I told people named big trends, they're like, oh, you're investing for multiple years. I said, no, big trends happen on any time frame. It can happen on a 30-minute chart, 60-minute, whatever time frame you like, the daily, weekly, monthly, even the very shortest term charts. But the point is, you've got to know where the sweet spot is and take advantage of it. My trading in my 21 years of big trends has evolved. When I was launching big trends at the end of the 90s, basically I said, I've got to take a little more conservative approach. I want to make sure I've got this money on hand, that I've got enough money as I start my business to basically endure the fact that I'm walking away from a nice salary job where I was director of research for another big options firm, and said, you know what, I need to go ahead and be safe here, right? So I'm trading higher delta options. I'm not getting as much leverage, but I'm basically saying, okay, I'm growing my capital. I was trading a lot of the internet brokerage stocks and other stocks that were hot in that late 90s run and doing very well, and saying, okay, I got plenty of money to start big trends now and share with people my approach to the markets. And that was the key. Of course, theta is the thing we've got to really be careful of. We do not want to have too much time decay. Time decay is our biggest concern when we buy options. We're not worried about vega on these option Greeks because that's something you got to worry about if you're buying right in front of earnings. We don't do that with this strategy. But gamma is a thing that's really involved for me, and saying, you know what, your actually best bang for your buck as an option buyer is buying the highest gamma rather than the highest delta. Delta means, of course, if the stock moves up $1 and your option goes up 80% of that buck, that's a nice trade and an option, but it's going to cost you more. It's going to be a more expensive option. And you're not going to pick up deltas very fast point by point on the stock. But gamma means that if you're going from out of the money to in the money, that rate of change of delta, you'll pick up the most deltas the quickest in those few points as we go from slightly out of the money to slightly in the money. That's where you see a huge delta boost when you're on the right side of that trend. I want to talk about that time component I mentioned earlier, because here's an example of Morgan Stanley, not typically your big name volatile mover, right? But everything was all systems go here as it broke out above this high here and confirmed at the end of this bar right here. So we bought right off of the open, we bought right here. And you can see initially we're wrong for the next couple of days. It would get knocked back pretty dramatically. That option was down more than 50% in 2 days. If you were putting a 50% price stop, you go, okay, I got stopped out on that trade. But if we count out from the first day into that trade, we start counting 2, 3, 4, and then the 5th day we're back to at or just a hair above where we got in. We got in right off that open. Not sure what's going on with my cursor there. We're saying, okay, after 5 days, we're just a little above where we got in. It's crunch time. We need to keep going up. 6th day, we're going up more. 7th day, gap up. We're cashing out right off of that open. On that open there, you can see we made a combined 220% when you add up the 3 pieces that we sold out of that trade, and said, okay, 220% is better than our usual total average, and we'll take the money and run. So think about that. If you were down 50, you could have been up 220. That's a 270 percentage point swing in your result. That's basically how to turn a winning system into a loser if you don't trade these options right. And so that's why I think price stops in the early going of a trade on this particular approach are not effective. They actually hurt you more than they help you. We've continued to test that, and it continues to test that way. Sure, every once in a while you could have done better taking that quick stop, but there's a lot of them that flip around on you, and you want to give it a chance to run. So now in terms of option selection, you say, okay, you look at this classic time decay chart. You know, most people would say don't trade anything too close to expiration. You got here 4 months from expiration is 120 days. 0, of course, is the expiration day. You say that last 30 days is where we lose the most rapid amount of time premium in those various 30-day intervals. But what my experience is that why would you just buy a 120-day option? You pay too much for it, and therefore you can't get the kind of leverage that I'm teaching you how to get 100, 200, 300%. It'd be very hard to even double a 120-day option on a 10, even a 20% move. You just have paid so much premium. If we're out here somewhere in the 40 to 30-day window for an entry point, so we say, okay, you know what, 40 days away right now, we'd start looking at, say, the January 2021 options expiration, 3rd Friday in January. And so, okay, you know, you've got, in that case, right about 6 or 7 weeks before the expiration. If you just take a 5-day sliver here, you know, from 40 down to 35 days, you can see, yes, you're losing that little bit of time erosion there. So yes, you're going to have a little bit of decay, but you don't have that rapid fall off until that last week or two. And that's why we don't trade anything with 14 days or less. We say stay away with 2 weeks to go before the options expiration on the monthlies. So for example, the first Friday in December, we would be out of any December positions, no matter if they're win, lose, or draw. So that way you avoid that rapid waterfall at the end of the time erosion chart, but you still get to get the leverage in that typically 3 to 6 week out from expiration window. Part of what I also teach people is it's not just about breakouts, it's also about what we call retests. Here's a CCI retest on this yellow line. It just means, hey, it was retesting right here on some bad news. They got some bad news about their privacy controls were not what they needed to be back in early April. You know, it's right. You know, stock had done well in the pandemic, of course, and then it came off real hard. And so, okay, now it's really crunch time here. Right into this big trends bands, it's held the lower band there 2 days in a row. We're saying, okay, now we believe we can get into this trade, and you start counting it out. Okay, and right as I got into this trade, I had this cars going, what are you doing? The stock's down. You know, it's had this bad news. Why would you want to step in here? I said, because it's about a risk versus reward trade. I believe the support's going to hold, and more importantly, I've got 5 days on a May 200 strike call. I've got 5 days here in early April to let this thing play out. So I've basically got 7 weeks to go, and I'm only using 1 out of the 7 weeks to see if I'm right or not. On the 5th, and then on by the 6th day, I was already at 101 and 200% gain on that 6th day. And at that point, I'm getting a little concerned because we're at the upper big trends bands, which would normally be resistance. And so on the 7th day, it started to roll over, and we got 117% and said, okay, you know what, it's giving up some of our profit. Let's take it out. And it did continue to run into there for a few days. Then it ran up a little more, then it backed off quickly. But the point being that when you buy calls on an aggressive name like this, you need to get validated quickly. If we don't, we need to cut and run quickly too. So that's why I buy a little bit more time, and then basically said I've still got the 5-day time stop that will kick me out if I don't get my targets quickly enough. The other thing that we do that's different at big trends versus a lot of other options strategists and gurus out there is that we don't just look at the stock chart, we also look at the options chart. What the heck is an options chart? It's just simply a price chart of the underlying option you might want to trade. And you say, you're going to trade an option. Why wouldn't you want to know how the option is performing, not just the stock that you're looking at? It's more work, but the point is, you know, that's why a lot of people have trouble moving from stocks into options. That's why I've been here for 21 years of big trends and 30 years in this options industry, because I've been teaching people about how to trade the right way, and it does involve more work when you move from stocks to options. You've got to factor in that it's not just about how good the company is, it's about the time component of the option. It's about how much volatility you're having to pay for it. That makes the option look very different than the stock. If you buy Apple stock, you know it should be here generations later, right? If you buy 30-day Apple calls, you need it to move in 30 days or less. In my rules, in 5 days. Haven't been messing with Apple lately. It's too choppy, too slow. You know, going through some consolidation. It appears after its last earnings report. So the point being, though, that the options chart will show you if the option's trending up enough to overcome the loss of time and or changes in volatility. So if you buy an out of the money option, you've got to get enough price movement to offset that. I know a lot of people will tell me when they get into big trends, and like, yeah, I've bought calls and puts before, but I was right on the stock making the move I thought, and it still didn't get paid much, or if any, or even lost on the option I bought. And that's because you paid too much time, too much volatility, or you just didn't get enough directional movement. So everything I'm teaching about here is about finding the big trends, finding the major moves, leaving the little fish to everybody else and waiting for the big fish to come along. And that's where you really get fed, and that's where you really get that big payoff. So the key is it just involves some patience and some watching things set up. You see, we've got our %R and CCI setting up here, and then our ADX came in a few bars later and confirmed, and we're saying, okay, we want to get in right here. Stock's trading about $77. We're buying them 80 strike calls. This was a while back, but point being, the principle is still the same. In about 6 days, we've doubled our money from 55 cents, sell at a half at $1.10. So $55 a contract, sell out at $110 a contract. And then we're right in front of earnings. It's the only time that I recommend holding something into earnings. We're getting a consolidation for the next few days right in front of the earnings gap, which you can see on this chart. And we told our subscribers, look, we've already gotten our risk capital back in your all's pockets, in our pockets. And you say, look, now we've got a chance with the trend still looking good. %R is still overbought. CCI is still overbought. ADX, the green line, is still trending up. All systems are still good for more upside. We think it's worth taking that risk from $79. The next day it opens at $84.30. We're saying, okay, now we're cashing that trade in. That 55 cents goes to, on the option chart, see $4.71 was our exit. So from 55 cents to that 471 was a 756% gain on the other half. Thank you very much in 11 trading days. That's the only time I advocate in this approach, rolling the bones into earnings, if you've gotten your risk capital out of the trade. If you're up 50%, unless you sold like two-thirds of your position, you know, it wouldn't be worth holding it into earnings. You got to be up double, take half off to get that risk capital back in your pocket. That's the biggest principle of not trading with risk capital into earnings with this approach. So I mentioned some of the names we like to trade. You see some of them here. Of course, a lot of big tech. Baba and Baidu is a couple of the biggest Chinese names. Microsoft, of course, all the FANG names are on our list. MasterCard and Visa in the tech sector, and the fintech, financial technology, and now, of course, Square and PayPal are part of that list as well. So we continue to add to it. Starbucks, Schlumberger. Barrick Gold actually bought out Randgold, so that's now GOLD's Barrick Gold. But NVIDIA, a lot of the big names of the casino stocks, which, you know, had a volatile run here up and down this year. And even a name like Mylan Labs, which has since changed its name, MYL was a symbol back here. And you can see, part of what I love about this chart is that the old phrase, the longer the base, the bigger the breakout. You see some of it stuck sideways for a while. And when you catch it coming off that breakout, this is a Thinkorswim chart now. Everything's like all systems go as it closes above this resistance right here. We're buying that next morning. Okay, it's kind of all of that first day we're in the trade. We're buying at about 40.5. We're buying about 5% out of the money, the 42.5 strike calls. We paid 62 cents, $62 a contract, controlling 100 shares. You can see this one took a little longer. It took 13 days to get our 300% final target. I don't mind that, but the point being that the trend, look at how steady that trend was. Look at how steady the overbought period was. Look at how steady the ADX, now in red, is trending up there. So the beauty of this is that persistence is really good once you get into those really good trend modes, that you're getting that kind of kind of self-fulfilling prophecy where the institutions, the individuals, everybody's feeling good about the trade. There's no pressure to sell, and there's more and more pressure for people missing out. That FOMO, fear of missing out, has been a big one here on a lot of these names this year more than ever. So our gamma boosting option selection choice to go with the option charts, and now about 60 stocks that are tailor-made for this strategy, makes for a really effective system. Sometimes you have to stalk the trade for sometimes months. It's one time where maybe stalking is a good thing, but don't advocate that. But for trading, I do advocate observing and being patient. On this first break here, setup here at 68, it took about a week for this thing to get going, and it gets going right here. It closes above it. All systems are go. We're buying that next morning on Schlumberger, the biggest oil services name out there. And with about 69 bucks on the stock, we bought the 72.5 call. I thought these were incredibly reasonably priced. We paid $1 for it, 100 bucks a contract, throwing 100 shares. And you can see that in the next 4 days, it was up 280%. On the 5th day, it got to 300. I just didn't update it, but you can see that the verticality principle is what we're after. That long sideways base, the bigger and faster and more potent that breakout. So, and again, all the other indicators kept us out of trouble. Through all these other phases here, you would not be trading, and not through that signal line. Only once you got through it and then the price action confirmed it with the follow through were you good to go. So that keeps you out of a lot of trouble. It avoids a lot of the fake outs. Always fun when you see notes from new subscribers like Srikanth said, feeling great to start the service with a winner. First time I've tried many services that he had that experience. So always fun to see that. Another one that was in the nice little pattern, you may kind of recognize this pattern because people talk about it a good amount, is the famed cup and handle. You can see here that we're getting this kind of resistance. We got this sort of cup forming here. We bought as it broke out of that first resistance, and we got kind of stuck in a handle ourselves here for a few days. Remember that I didn't know it was going to be a handle. I thought it was going to break straight out. I was wrong. But you know what? Once we're in the trade, you start counting. Count your numbers. You go 1, 2, 3, we're down a little bit. 4, we're back to where we got in. 5, we're going profitable on the stock. 6 and 7, we're still above where we got in. You can see drawing that out over there. We're still hanging above where we got in. If we came back under that 68-ish level there, we would have a problem. Instead, it takes off, goes ballistic. This is on Akamai, one of the internet backbone kind of names on a lot of the hosting out there. What's great about this, you could even do it. This is a thinkorswim chart on a 30-minute chart. Same principles apply. You can apply what I'm teaching you on any time frame. So you start to see, even look at the CCI just down here in these little blocks. You can see the first time we got in, we were maybe, you could say, a little bit late after that first breakout, but that's the daily chart required a little bit of that kind of confirmation. That second little wave here got a nice little quick move, but the third wave was the most powerful wave, right? Just that one little block right there, we got all of our targets on that 7th day in the trade. Later it came out that right after the close that a big investor had bought a bunch of Akamai stock and was pushing for board seats and more of a shakeup inside the company. It gapped up initially and then came shooting back down. We're already out of the trade, not worrying about that kind of volatility. Saying thank you very much. We've already taken our money in 7 trading days. We can do the same thing on the downside. So if you look at like an Alibaba trade, and sometimes even I get a little concerned on a few of these where I'm like, okay, stock's about 160. I've got a very clear breakdown signal on Alibaba, and I've got to buy a 140 put. That means if you're new to options, I've got a right to sell the stock at 140. It's at 160. To go to at the money, it needs to drop 20 points, or just over 10% of the stock into by the middle of October. So we got like 5 weeks to go on this option. I'm going, I need this to prove it out very quickly. The very next day, it gaps down 5 points, we get our double. So that's the point, is that you don't have to worry about it getting in the money when you trade these. You just have to catch part of that sweet spot of the move. Now we've got a free trade. I'm saying, well, you better keep proving it to me. It gaps down that next morning, but by the end of that second day where it's flipping back up and we go, we don't like what we see here. The momentum is not continuing. We bail at 69% on the second half of the trade. Gain. So we average on that trade, you can see about 84% or so. But the point of this is that, then it's just kind of stuck in the mud, not much is happening. So even if it doesn't go against you, if it just kind of flattens out, that too is a better exit to go ahead and say, I'm not seeing what we need. I'm especially here trigger on those put signals where I really want to get that fairly quick confirmation. So like US Steel, when it broke down in the past, you can see the breakdown point, all 3 of the indicators are breaking down right here. and then it confirms 2 days later, not the next day, but the day after. That's a bear confirmation. So we're getting in that following morning here, just under 32 bucks. Buying a 30 strike put, about 6% out of the money, paid 86 cents or 86 bucks to control 100 shares on the downside. And it quickly went from 32 down here to about 29 and a half, down to about maybe 28 and change, low 28s. That option was up to about 150%, but didn't quite get to 200%. This starts to flip back up. We're out here and saying time to get out. X marks the spot of exit. 66% of the second piece. We average, as you can see, about 83% on that trade. So, it took 8 days for that to play out. You can see most of the indicators are still looking pretty bearish, but we've got some rules that just keep you from getting into a trade too long and holding and hoping. So a lot of my subscribers will send me nice notes, like Robert Ramin said, he was struggling with entry and exit. He started using my %R method and started to have a lot of success. I've highlighted, he said his portfolio almost tripled in a matter of a few months. He had more 100 and 200% winners than he ever had in the past. So the beauty of this is that, okay, you're able to keep your losers controlled, let your winners run. And of course, he now uses that as his primary trigger for all his trades. So, it's something where you say, okay, that's something we're definitely always looking to build that confidence in our subscribers to know that you're going to have a method and a system. I'm always big on teaching you too. So I'm always giving you weekly video updates every week on the trades, whether they're winning or losing, and saying, here's what I'm thinking, here's what the indicators say, here's what we're doing next, and here's where the market is positioned. So here's some of the things we're looking at for future opportunities. GM was one that I actually got bearish on coming right off of the bottom there in late March. They were saying we're going to start making ventilators, which is good for, people that were very much in need. But I thought, is the auto business that bad that, nobody's buying? That's not what you want to see as a business. So we're saying that's right into what we call a CCI retest right in here. So we want to get bearish right there. And stocks trading, you can see here, just over 22. We're buying the April 18 puts. The options are definitely not cheap. We paid $100 a contract, a $1 option there. And you can see we're right. The stock drops from about 22 back to 18 on the 5th day. This is a case where I said, you know what, we're right back into our big trends bands. We're going to take that off the table at the 50% gain. I just was expecting it to drop back down to the old lows, closer to 15 very quickly. And it was a good thing we did, because then, of course, it flipped back up. And now GM's become like the hot stock on the upside. Everybody's talking about electric vehicles and GM's roaring to the upside. It doesn't trade well in our system on the upside. It does better on the downside, and so we haven't participated in that. So sometimes, I use history as my guide, and sometimes it'll cost us some opportunities. But my thinking is I'd rather trade the ones that have the best profile based on 10 and 20 years worth of past data than just catching one fleeting little uptrend that happened to be an outlier. So anyway, point being that our keys are, you got to have a catalyst here. You got to have a driver. And for me, it's all 3 indicators have to fit, not 2 out of 3. All 3 have to fit and be right in their sweet spot. If they're not, then I say, okay, the stars are not aligned. It's not time to trade that yet. We wait when we may even miss. So again, I tell people it's okay to miss a train leaving the station. There's going to be another one. I don't want you chasing it off of the end of the ramp or getting run over, or worse yet, or jumping right in front of a speeding one. I want you to say, look, let's get on as it's just starting to get that momentum going, easy enough to jump on and then ride to the destination in a very smooth way. We buy out of the money options. They're never going to be in the money with this approach. So $1 or less, that's that higher gamma where you can hit the really big home runs with options trading and option buying. Our time stop at 5 trading days, if the stock's flat or against us, says, okay, don't get whipsawed by a little bit of an adverse move. With these options, they can get moved all around because of the fact that they're really not based on intrinsic value, but based on the perception of how valuable they could be down the line, based on that stock's volatility and the time remaining. Windfall gains are booked gradually, 100, 200, and the final 300% on those gradual moves in our favor. The key is do not overcommit your capital. In January, we just had an insane month, for example, and I told people it's not going to be that easy every month. I think our portfolio, even investing no more than 10% of our capital per trade, or on a $10,000 portfolio as a model. So up like 70% in a month. I said, that's just absurd. I don't expect that to continue. And it didn't. Of course, you saw what happened with the pandemic. But the key is that we didn't get too high off of that. We didn't say, now you should load the boat on the next trade. That's not how you want to think. You want to always be cautious, always know that it's about getting rich steadily, not trying to get rich too quickly and take too much risk. The big thing is the weekly video training. It's a constant education model here at Big Trends with Grand Sum Options. You're going to learn whether trade worked or didn't. I'm never going to just not talk about it. I'll talk about every trade we've made, good or bad, and you'll know where everything stands and how we're growing the portfolio. If you came in late, you saw how much it had grown over the past few years, and you can see that in this case, $10,000 model portfolio up to about $33,500. That's a $23,500 profit before commissions. And like I said, now commissions are down to next to nothing for option trades. Whereas when I got started in 1990, I remember getting a ticket charge for like $50 on something and $30 on something else for like not even a 10 lot, and so it's one of those things where you're like, okay, commissions have come down so much. It's really a phenomenal time to trade options. Now, usually this is $299 a month for my Grand Slam option service, up to 8 trades a month. So we're not going to pick but what we think are the best of the best, cream of the crop opportunities. And so an average of a couple of trades a week. For 1 month, 30-day access is usually $299. For my most loyal subscribers, I usually will go down to a monthly auto bill at $147 a month. But for you all, I'm going to give you, Dave and Anka have been so good to me. I'm going to give you all a chance to try this out for just 30 days for just $47. Why do I not do free trials? Because I find that for low dollar trials, people won't invest any time to follow it, to learn. If you pay just a little bit, it commits you to say, I paid a little bit. I used some of my good hard-earned money on this. I need to spend a little time learning it, following it, and believing in it. Because obviously, I don't expect you to believe it until you see it in action. And the great thing is when you become a member, and you can see the link that we've set up here for you at members.bigtrends.com/slam. That link is a members.bigtrends.com/slam link. That will then give you that ability to see this page pop up here. Let me show you that real quick, and then I'll answer a couple questions and hand it back over. But basically, you can see, cut it already down to $47. You just go to that page. No long words. No hype. It's basically you get what you get: 30 days access to Grand Slam options with the weekly video training for just $47 here today. Lock it in and try it for 30 days. After 30 days, it will auto bill at $147 every 30 days. So you can cancel in the first 30 days and only have paid $47 if it's not for you. I think it's going to be more than worth your investment in the small amount of dollars, and more importantly, the investment of time that you make to start learning the Big Trends methods to find the next big moves up and down. You just hit the green checkout button after you review those terms and conditions, get all your information in there. If you want to get text alerts, I do ask that you can say you saw it with me on a webinar. Text alerts in that customer note box. Just put whatever number you want, and then put what service you use. If it's AT&T, if it's Verizon, put in whatever provider you've got with your number in there. Review the terms and conditions. Like I said, we even break it out again that it's an auto renew program every 30 days, 147, but you try it for the first 30 days for just $47. Let me go back over for a second and see if there were any questions I need to answer real quick before I hand it back over. I want to make sure that it hopefully sunk in with you and made some sense as to what I was keying on here for you. Let's see if I can pull that up. For some reason, my Zoom doesn't want to pull up for me here. Maybe David, do we have any questions that I need to answer?
Let me see. Does NIO trade well for your system?
Yeah, NIO has actually been that's a great question. NIO has been a phenomenal name this year. It's not been one because it's such a new stock, right? It's China EV name. We nailed it in one of our other products we call stock doublers for not just a double but a quadruple buying the stock. So Brad, so you asked that question, and yeah, Brad, I mean, it's one we're now saying, do we have enough data going forward to trade it better? But yeah, it's a perfect example of a big trend that even though the options were fairly pricey, that you could have made a lot of money very, very quickly. Brad mentions also what's the next CMGI. That's one that actually helped me found Big Trends. That was one of the internet incubators from the late 90s that was very good to me in that late 90s run, but obviously got out of it before it then crashed and burned. So a big part of this is all about catching in that sweet spot and not worrying what's going to happen a year from now, but worrying what's going to happen in the next few days from now. So thank you, David and Anka, for having me. It's been a pleasure. If anybody else has any questions, at the bottom of the page, you can see you can reach me at 800 Big Trends or shoot an email over to us there at the very bottom there, clientcare@bigtrends.com. We're here to help. And so always a pleasure. Wish you all a great Thanksgiving. I look forward to seeing you again real soon.